Ever feel like you're drowning in data when trying to follow complex financial news? How do you actually get to the crucial insights? Well, that's exactly what we're aiming to do today. We're taking a deep dive into Newgen Software Technologies Limited's Q1 FY26 financial results. And we're not just going to list the numbers. We want to uncover the why behind them, what it might signal for what's next. We've pulled together info from their official filings, press releases, the investor presentation, and really importantly, their recent earnings call. Our mission for you listening is to give you a concise but still thorough understanding of Newgen's performance, their strategic moves, and the future outlook, basically to help you get up to speed quickly on this. Okay, so let's unpack these Q1 numbers then. What did they report? Well, Newgen Software brought in a total income of 350 crore rupees for the quarter ending June 30th, 2025, and their profit after tax, or PT, was 50 crore rupees.
Right. And the consolidated revenue from operations specifically, that came in at 321 crore.
Which is up slightly from the 315 crore in the same quarter last year, Q1 FY25.
It is, but they did flag in the investor presentation that this was, and I quote, impacted by softness in deal closures.
Okay, so that softness is key context. And that 50 crore PAT, how does that look as a margin?
That works out to a 15.5% PAT margin for the quarter. Pretty decent.
And were there any, standout positive signs despite that softness?
Definitely. Subscription revenues, for instance. They hit 121 crore rupees.
Oh, wow.
Yeah, and that's a strong 19% year-over-year growth. They call this a key annuity revenue stream getting back on track, which is very positive.
Good sign for recurring revenue. Anything else?
They also secured 12 new customer logos during the quarter, spread across different geographies too, so showing continued market reach.
Okay, 12 new logos. And just quickly on the corporate action side,
Yeah.
dividend, ESOPs.
Yep. The board recommended a dividend of 5 rupees per share for FY25. That's subject to shareholder approval, of course, at the upcoming
A
AGM.
standard procedure.
And they also did some ESOP allotments, issued about 53,600 equity shares to the Newgen ESOP Trust, and granted some options too. Fairly standard stuff to incentivize employees.
Right, aligning interests. Okay, so that's the what. Now, the really fascinating part is the why. What's the story behind these numbers?
Well, what's truly interesting here is the context management provided. They straight up called Q1 a muted quarter.
Okay.
They pointed out it's traditionally a seasonally weak quarter, but this time that weakness was further accentuated by current conditions.
What kind of conditions?
Essentially, customers are just taking more time and being cautious in decision-making. That's the big theme.
And why the caution?
It boils down to the uncertain economic and geopolitical environment. They specifically mentioned things like U.S. tariffs and global conflict, the usual suspects causing jitters.
Right, the macro headwinds we keep hearing about. And how did that caution translate into their business?
It led directly to a slower funnel conversion. The pipeline of potential deals just wasn't closing as quickly as usual.
So, delays.
Exactly. Deferrals and closure delays, especially for the larger deals. It's important to note, though, their deal win rates have been the same. They're still winning business across geographies and segments, insurance, financial services, government.
So they're not losing out to competitors necessarily.
Doesn't seem like it based on their commentary.
Yeah.
It's more that the bigger programs, the ones in that 20 to 50 crore rupee range, are just seeing slower pattern decision-making.
Yeah.
Clients are hitting pause on the huge commitments.
Okay, so instead of the big fish, they're landing.
More tactical, smaller deals, generally in the 4 to 9 crore rupee range, which naturally impacted license sales. They were lower than last year simply because the average deal value was smaller.
Got it. So it's not a lack of interest or losing bids. It's just clients pumping the brakes on the really big spend right now.
Precisely. And that slowdown wasn't just hitting new license deals.
Okay. What else?
Implementation revenue was also slower, partly because of those smaller new deals coming in, sure, but also because some previous large orders are apparently in a slow-going execution mode.
Meaning projects already underway are progressing slower.
That's right. So they're realizing less revenue from the existing order book than they might have expected, just because things are taking longer on the ground.
Interesting. And did this play out differently in different regions?
Yeah, there were some geographical nuances. In India, for example, the momentum on public sector digital lending platforms, the DLP solutions, that slowed down a bit.
Okay.
But other areas like trade finance seem to be picking up. They also noted a pullback in retail lending because of risk concerns, but secure lending still has legs, leading to more single product journeys.
Single product journeys, meaning smaller, focused projects instead of massive overhauls.
Kind of. Automating maybe just one part of a process, not the whole end-to-end transformation. And in the Middle East,
What about there?
they saw a slightly slowdown of spend in banking generally. And some very specific local issues cropped up too, like apparently Q1 Saudi visas were blocked, maybe because of Hajj season.
Huh, really?
Yeah, and that directly hit business travel, which obviously makes closing deals harder in that region.
Wow, okay. So, given all this caution and delay, what's the outlook? Are they expecting this to continue?
Management seems to think the slower decision-making impact will sustain in Q2. So the current quarter might still feel some of that drag.
But looking further out.
They expect a better deal momentum in H2, the second half of the fiscal year. They're still pegging the whole year for growth, but they were quite candid, saying it's very difficult to project if they can hit their typical, say, 20% growth outlook, given the huge uncertainty right now.
That's a very clear picture of the headwinds, definitely. But you said they expect better momentum in H2 despite that uncertainty. What gives them that confidence? Seems a bit hopeful.
It's a fair point. I think their confidence really stems from the fact that, according to them, the funnel continues to be strong.
Meaning the pipeline of potential deals is still healthy.
Exactly. Lots of qualified leads are still there. They seem to view these delays more as deals being pushed out rather than being canceled. The underlying demand, they believe, is still holding up, even if that conversion cycle is just taking longer.
Okay, so the deals are delayed, not dead, in their view. So how is Newgen actually adapting its strategy then? What are they doing to navigate this and try and get those deals closed?
Now, this is where it gets really interesting, I think. They're leaning heavily into innovation, particularly AI.
Ah, yes, the AI pivot.
Absolutely. They're making significant investments in AI-driven products and solutions, leveraging both machine learning and generative AI.
And applying it where?
Across the board, it seems, for better decision-making, automation, personalization, creating more intelligent user experiences, basically weaving it into their workflow platform.
So it's not just talk. Doesn't sound like it. They stress that AI-led use cases are actively driving deals and customer discussions across all verticals. They even highlighted specific products, Marvin for task automation, Harper for client conversations, designed to deliver value cost-effectively.
Right.
And get this, they noted that something like 70 to 80% of their current use cases involve AI as a central or substantial part.
Wow, 70–80%. That's quite embedded already. It's an aggressive move.
It really is. And you see it not just in the tech itself, but in their broader strategy too, right?
Yeah, absolutely. It's not just about the shiny new AI tool.
Exactly. They're reinforcing their core business fundamentals too, sticking with their vertical-first go-to-market strategy.
Focusing on those industry specialisms.
Right. Focusing on what they call journey clusters in banking, insurance, and government. Think of those as like pre-packaged solutions for specific processes, opening an account, applying for a loan, making them smoother end-to-end.
Okay, so deep vertical expertise plus AI.
Seems to be the plan. And despite the slower Q1, they're not cutting back on future investment. They put 9% of revenues into R&D.
Which is substantial.
And about 26% into sales and marketing. Shows commitment to growth even when things are a bit tight short term.
And those investments are paying off in other ways too, aren't they? Like intellectual property.
Good point. They secured a new patent, something about a system and method for data compression. Brings their total patents to 25 now.
So basically a smarter way to handle large amounts of similar data more efficiently. Useful tech.
Definitely. And they're getting external validation too. Got recognized in the Gartner Market Guide for U.S. healthcare provider credentialing, and also in Forrester's DPA software landscape for Q2 2025.
That industry recognition always helps build credibility.
For sure. And financially, backing all this up, they seem pretty solid. You mentioned the PAT margin, but what about cash flow and working capital?
Very strong, actually. They showed robust cash flow generation.
Yeah.
Net cash from ops was 81 crore rupees for the quarter.
That's healthy.
And their net DSO days sales outstanding was only 123 days. That's pretty efficient. Means they're collecting cash quickly. Good working capital management.
Okay. And the recurring revenue piece. You mentioned subscriptions were up.
Right. Those annuity streams overall. So support, cloud SaaS, subscription licenses brought in 222 crore rupees this quarter.
A big chunk of the total.
A very big chunk. For the full year FY25, annuity revenues made up 56% of their total revenue. That points to a really resilient business model. less dependent on those big, lumpy license deals.
Yeah, that recurring base is crucial in uncertain times. And their track record supports that resilience, doesn't it?
It does. Looking back from FY23 to FY25, they've shown an 18% compound annual growth rate in revenues, 24% in those important annuity revenues, and an impressive 34% CAGR in profit after tax.
Wow, 34% PT growth
Yeah.
CGR.
Plus, they mentioned having 87 customers who billed over 50 million rupees, or 5 crore, in FY25. So
Yeah.
deep relationships with significant clients.
Okay. And just for completeness, any red flags from the auditors?
Nope. Walker, Chandiak & Co. did their limited review, no qualifications in the report. Plus, Crystal reaffirmed their short-term rating at A1, so clean bill of health there.
Good to know. So let's connect this to the bigger picture then. What's the road ahead look like based on all this?
Well, as we touched on, management is banking on that second half recovery. They firmly believe the funnel continues to be strong,
Right, the pipeline.
and that deal closure would gradually improve in the coming quarters, leading to better overall growth in the second half. They also expect annuity revenues to continue to pick up growth with project closures.
So despite the Q1 bump, or what they called the intermediate jerk,
Yeah, the intermediate jerk. Their internal plan is still very much for a growth year. They're not just aiming for historical rates either. They want to accelerate the growth rate above our historical growth rates to reach higher. Very. They recognize the total market size, the TAM is very, very large, and they feel the market is not a bottleneck. It comes back to that view that current delays are projects being pushed out rather than being canceled.
okay, playing the long game, believing the demand is there. But growth often comes with pressure on costs and competition, right? You mentioned earlier the low-code market is getting very cluttered.
That's a critical point,
Yeah.
absolutely. On the cost side, they do expect wage costs to increase, to retain talent in this market.
Always a challenge.
But they anticipate balancing that through enhancement of productivity, through automation and AI,
Hmm.
using their own tools, essentially, to keep costs in check and maintain profitability.
Makes sense. And the competition. How does that vertical knowledge really hold up against the big global players like Salesforce or ServiceNow moving into their turf?
It's definitely getting crowded. You've got those global giants pushing into markets like India and the Middle East, plus strong local competitors and new AI startups popping up. It's noisy out there.
So how do they stand out?
Newgen believes their very strong strength comes from that deep vertical knowledge and expertise. Understanding the specific pain points and processes in banking or insurance or government gives them a strategic advantage that a more generic platform might struggle to replicate quickly.
So specialization is their moat.
Essentially, yes.
Yeah.
And so far, they say they haven't seen significant losses to competition or major pricing pressure, which kind of backs up that specialized value proposition.
Interesting. And are they adapting their sales strategy too, beyond just the tech?
They are. They're actively expanding their target market, maybe looking at slightly different segments or sizes of companies. And crucially, they're aiming to increase the velocity of deals for those smaller tactical projects we talked about.
Ah, so land more smaller fish, faster.
Exactly. They're targeting a jump from, say, 60, 70 wins of that type per year to maybe 100 wins. It's a way to compensate for the slower pace of those big multi-core deals closing right now. A clear tactical shift to keep revenue flowing while waiting for the larger ones.
Okay, that's a comprehensive picture. So wrapping this up, what does this all really mean for you, the listener? Well, while Q1 definitely presented some challenges for Newgen, mainly around slower decision-making on those big deals, they're certainly not sitting still. They're actively responding. You see strategic integration of AI right into their core offerings. They're diversifying their market approaches with those faster tactical deals. And crucially, they're continuing to invest significantly in R&D and sales for the future. And underpinning all that is a foundation of robust cash flow, efficient operations, and that growing base of resilient annuity revenue. It gives them room to navigate this more cautious economic climate, which really raises an important question, something for you to think about. How do you see companies like Newgen balancing these immediate impacts, the cautious global economy, the slower client decisions, with those necessary long-term investments in potentially transformative tech like AI? Especially when client decision cycles for big projects can stretch out for months, sometimes even years. It's a tricky balancing act, isn't it?